Good morning. This is Matt Dunbar, and I am the co-founder and managing director of the South Carolina Angel Network. And I'm pleased to be with you this morning for the next in our series of Crowder information education sessions through our nonprofit education arm called Venture Carolina. As we start the broadcast today, I'd like to point you to some resources available to you to follow along with our discussion on our website. So if you will scroll down on the Crowder View broadcast page, you'll find a link to our website, to the investor resources page. If you don't happen to see that link, look for venturesouth.vc. That's a new brand name we'll be rolling out in the next few days. But venturesouth.vc, and go to the investor resources page, and you'll find a series of links to several of our Crowder educational sessions, including the one for today. You'll see some slides as well as some posts, blog posts that my colleague Paul Clark has written on our website to walk through in more detail some of the topics we'll be talking about today. So I'll refer to those slides for the first few minutes of our discussion today, and then we'll try to spend most of our time fielding questions you might have about returns to angel investors, as well as some important regulatory impacts that may be worth watching on the angel investor front. So without further ado, I am going to switch over to the slides and talk through those. So I hope you've been able to find those again on our investor resources page on the venturesouth.vc website. If you will find those slides and move to the second slide, let me just tell you briefly a little bit about our organization. So as I mentioned, Venture Carolina is an educational nonprofit that seeks to improve the know-how and the knowledge of both entrepreneurs and investors in the early stage investment space in and around the Carolinas. So we do a series of educational workshops and Crowder info sessions like the one you're watching today. The South Carolina Angel Network is a group of affiliated angel networks across South Carolina and up into western North Carolina. And we gather over 200 investors each year to make early stage investments. We have funded over $17 million worth of investments in 50 companies over the last 8 years. And we continue to try to build the ecosystem for early stage investors and entrepreneurs in the Carolinas. Crowder is one of our most recent investments. It is an online platform that is the first of its kind to allow crowdfunding to be integrated with live streaming. So if you are a politician that's looking to raise money and you want to interact with your audience in a more dynamic way and reach more folks than you can in just a single town hall meeting, you can set up a Crowder session, talk about your perspectives, and invite people to contribute to your cause or your campaign right in the platform. So you'll also notice that that's available to you today as we go through the Crowder session. If you find any of this information valuable and you want to contribute to Venture Carolina, which is a 501c3 nonprofit, therefore a tax-deductible contribution, feel free to do so, and we would certainly appreciate it, and we'll say thank you live on the broadcast. So that gives you a quick sense of who we are and what we're doing. So without further ado, let me go ahead and dive into some of the content for today. Excuse me one moment while I move the slides here. So let's jump right in. Again, we're here today to talk about investor returns for angel investors and also give you some insight on some important regulatory items that are making their way through the regulatory system as we speak. So let's start with angel investor returns. And what I'd like to do is share some findings with you that were recently published from a study called the Tracking Angel Returns Study, which was sponsored by the Kauffman Foundation and NASDAQ through the Angel Resource Institute, which is a sister organization of the Angel Capital Association, which seeks to build the industry for angel investing in North America. The Angel Resource Institute does a lot of research in this space and a lot of education as well. So they're a great resource for those of you looking for more and deeper insight into angel investing. Rob Wiltbank is a leading researcher in the area of early stage investments. He has previously done some studies on angel investing. He wrote the seminal study really on this topic back in 2007. And then over the last couple of years, he's been working to update that along with the director of the Angel Resource Institute, Wade Brooks. Both of those researchers have a base at Willamette University in Oregon. Professor Wilbank and Professor Brooks have recently updated this study that I'm going to share with you today. You'll see some new findings as well as some comparisons to previous studies that they've conducted. In the study they conducted back in 2007, they surveyed angel investors across the country and got them to report their own results. So of the investments they made, how many had generated a return, good or bad, and they collected quite a bit of data, over 1,500 data points for that study. When they attempted to do that same type of data gathering in this most recent study, they had a little bit less response. So they looked at some alternative ways to gather that data. So the two ways that they did gather that data are listed on the slide in front of you. One set of data came from something called the HALO report, which is a database that the Angel Resource Institute is building over time. So angels and or entrepreneurs can report fundraising activities into this data set. And so they used that data set as one piece of the input to this study. And then the other set they use is what they call the angel fund set. So they surveyed a number of angel funds across the country, funds who have committed capital as opposed to networks like the South Carolina Angel Network, which is a network model. So folks don't commit capital up front. They make investment decisions on a deal-by-deal basis. Most funds have a more standardized, rigorous reporting function, and so Professor Wilbank was able to go to them and get a better set of data than he could just by surveying individual investors. So we got the HALO report set, and we've got the angel fund set. In the HALO set, again, these are numbers reported through the HALO report that the ARI puts out on a quarterly basis. There were 356 firms that were identified as part of that process prior to 2012, and 109 of those had now had a completed outcome. So either a good or bad outcome, an exit, a successful exit, or a failure, a shutdown, a loss of capital. Of the exit events, a few happened prior to 2010, about a third happened between 2010 and 2012, and then the majority happened within the last 3 years. On the angel fund set, again, these are U.S. angel funds with a rigorous reporting mechanism. They had 31 funds were contacted, about 20 of those participated. So there's some good and bad with that data. I won't belabor those points here. There's always a little bit of risk of bias in some of the data you collect, but among those funds, there were 136 completed investments. Again, the majority of those exited in the last 3 years, about a quarter more from 2010 to 2012, and about 10% prior to 2010. So those are the two data sets. If you look at the next slide, you'll see the results, the beginning of the results from those two data sets. So on the HALO report side, you'll see that the median size of the angel investment round was about $500,000 as opposed to a larger size for the angel fund set. That was about $1 million as a median round size. The averages or the means were higher, so about $900,000 from the HALO report and about $1.3 million from the angel fund set. So you can see the rough size of typical angel investment rounds reported by companies and reported by funds. It looks like the fund investors are participating in slightly larger rounds, which is perhaps not surprising because they already have committed capital on hand. The dots in the middle show you the mean or average ownership percentage of the angel round. And so what's interesting about that, despite the difference in size between the two data sets, you see a fairly similar ownership percentage. So in other words, when those angel investors invested, they typically bought somewhere between 21 and 23% of the equity in the company at that point, which is consistent with our experience that we would typically see 20 to 30% equity ownership for an angel round in our market here in the Southeast. So a pretty well expected result from the equity ownership position for these angel investment rounds. And again, you'll note that the subtitle here indicates that these are for rounds that only involve angel investors. So they exclude rounds that might involve venture capitalists with larger funds that therefore would skew these numbers higher in terms of the total dollars invested. So if we go to the next slide, you'll see the distribution of outcomes from this data set. And so let me walk through what you're looking at here. On the left axis, you're looking at the percentage of total investments that were reported from these different data sets. And on the horizontal axis, you're looking at the net cash returns generated by these data sets. So you can see in the black, we're looking at the Halo set. Again, these are companies that reported through the Halo report. And so if you walk across from left to right, you'll see that about 75% of those reported companies, or those companies reporting, generated an outcome that returned less than 1 times the investor's capital. You can see that about 15% generated 1 to 5x returns for the investors, and then so on and so forth out to the right, such that you see it was a fraction of just 2 or 3% of companies that generated a 30x return for those investors. So a pretty typical skew between pretty high failure rates that return less than 1 times capital, and then a small percentage of the deals, maybe 6 or 7% total, that generated 10x returns or more. And that's generally where investors make most of their money, is that small slice of their portfolio that hits home run returns and makes up for the losses that you see on the left side of this axis. On the angel fund set in blue, pretty similar numbers, a little bit lower failure rate on the front end, about a little over 60%, and then again a similar single-digit percentage total returns of 10x or more. The numbers on top of the bars show you the actual amount of time it took in years to realize those exits. So not surprisingly, the losers tended to lose faster than the winners win. And so you'll see 3.5 to 4.5 year stamps on those bars on the left that indicate those deals failed within that time period, whereas the 10x returns out on the right took 8 years or more. So part of the takeaway here for angel investors is, if you're going to participate in this asset class, you've got to be both diversified to have a chance to be in not just the losing deals, which is the higher probability, but also a chance to be in the home run type deals. So you've got to diversify, and you've also got to be patient. So you've got to approach this asset class with that kind of mindset if you want to really have a chance to be a successful angel investor. When you net the outcomes from these distributions, you'll see the Halo report generated a 2.3x return for angels, whereas the fund set generated a 2.8x return. Hold years were between 4.5 and 5 years on average, and IRRs across the board of 20% for the Halo set and about 25% for the angel fund set. So these are some pretty interesting numbers. They indicate what prior studies have shown, and we'll look at those in a minute, that angel investors can expect to generate pretty significant returns in their portfolio. Again, provided that they're diversified and they're patient, they should expect to generate a 20+% rate of return over a long period of time. So let's compare that with what prior studies have found and see what these numbers tell us. You can see on the next chart the distribution of outcomes comparing this most recent study with prior studies. So in the reddish color is this 2016 angel return study, which is a combination of the Halo set and the angel fund set. So net across those two data sets, on average, you came out with about a 2.5x return, 22% IRR. And that's what's reflected in the red bars. Again, you see on the left-hand side, about 70% of the deals failed or returned less than 1 times the investor's capital in this most recent set, versus prior studies which showed a 50 to 60% range. So a little bit higher failure rate. We'll speculate on why that might be in just a moment. As you go out to the right, you can see, again, the comparison. And what we're comparing this to, this most recent study, are 2 prior studies. The one I mentioned previously that Professor Wiltbank completed back in 2007, which surveyed angel investors that operate in angel investor groups. That's in the blue bars. You can see it was about a 50% failure rate in that case. But again, similar low percentage, high exits on the right-hand axis. In 2009, there was also a study done in Europe and the UK, and you can see very similar results from that study in 2009, with roughly half the deals, a little over half the deals, returning less than 1 times the investor's capital, and single digits returning 10x returns or more that really generated outsized returns for those investors. And on the next slide, we'll see what those IRRs look like. But before we do, let me just speculate for a moment on the bars on the the left-hand side of this chart with the higher failure rates in the most recent study. This is pure speculation on my part, but I think there may be a couple of factors that skew that number higher in the most recent study versus the prior studies. I think certainly the recession that we hit in 08 and 09 that would have impacted a lot of the companies in this data set certainly would have driven some higher failure rates than we might have expected normally. An unusually steep and drastic decline in economic activity, and certainly fundraising, if you look back over that time period, would have impacted a lot of those companies' ability to raise capital and or sell into the market. So I think we probably had some higher failure rates during that period. There's also always a little bit of reporting bias. So it may be that some of the failures that were incurred weren't reported fully in those earlier data sets in terms of the methodology of how that was accrued. And it may be that some of these more recent data as well haven't yet matured to the point where we'll see over time some more companies mature in those portfolios, which will lead to better outcomes as they reach exits. And so that might bring down the total failure rate over time of the most recent data set as we give it a little bit more age. So those are just a couple of points to speculate on why that distribution might look a little bit worse today than it did a few years ago. But certainly as an angel investor, you have to go in expecting that failure is more likely than success. So again, it pays to be disciplined and diversified and patient to get to good outcomes. And this session is not really focused on the discipline part of this, but certainly angel groups and that kind of infrastructure give investors the kind of discipline you need to try to do the best you can to draw on the wisdom of other experienced angels to try to avoid deals that are likely to fail, and really try to make your bets on those that might have a chance to fall into that bucket out on the right that could be a 10x type return. Certainly we can't predict the future. Again, that's why we've got to diversify and really make sure that we are exposed to a significant number of deals. But with the discipline of a rigorous process, we do think that we can mitigate some of our failures we might incur if we were doing this just on our own as angel investors. We benefit a lot from the wisdom of others that have done this before, but they might know something about the industries we're considering an investment in. So again, just to wrap this up, if you look at the angel group returns, we're looking at the 2016 study on top, which showed a 2.5x return on an average hold of 4.5 years, which generated a 22% IRR. Again, the failure rate is higher than what we've seen in the past, at least currently in that data set. And then the last column in this chart shows you the percentage of returns that were generated by the best 10% of the portfolio. So 10% of the exits or outcomes in the portfolio generated 85% of the returns. So again, just it goes again to underscore the skewed nature of the distributions in this asset class, and underscores the point that you've really got to diversify to give you a chance to wind up in that 10% of deals, as opposed to only being concentrated in one or two that are likely to fall into the other 90% with less exciting outcomes. If you look at the 2007 study, similar numbers, 2.6x return, a little bit shorter time period, 3.5 years. So again, the recession in 08 and 9, 10 may have played a part in the longer hold periods more recently. A little bit higher IRR because of that shorter time frame, a little bit lower failure rate. Again, we talked about that, but similarly, 10% of the exits in that study generated the vast majority of the returns, about 90%. Similar story in the 2009 study, siding with the angels, 2.2x return, 3.5-year hold, again, 22% IRR, 56% failure return less than 1 times investors' capital, and about 80% of the returns were generated by 10% of the portfolio. So those are some angel studies in the comparison. So I think what we find in this most recent study is that angel investing continues to be a very attractive asset class that can generate very attractive returns. Again, if investors are patient and disciplined and diversified, and certainly relative to other places where you look to generate returns, these can be double or better returns you might get in public markets. Last comparison on the page is Professor Whitbank pulled in some early stage venture capital data from Cambridge Associates, looking back over a similar time frame as the data that he reported in his most recent study, and you find similar results. So a little over 2x return to those early stage VCs, a little bit higher IRR, which we might speculate on. Perhaps the venture capitalists have a little bit more control over the exits in those companies as they potentially own more of the company, have a little more influence at the board level. You can drive that exit process process and maybe generate a little bit faster exits and perhaps a little bit larger returns. So again, very similar to early stage VCs and perhaps even more favorable on the angel investor front. You can speculate for lots of reasons on why that is, but I'll refrain from that for now, but happy to take questions about that in the Q&A session. So those are some results from the broad angel investor community. I'll tell you that for the South Carolina Angel Network, we believe that we're tracking for very similar returns. Most of our portfolio is still very young. Over 60% of our capital has been invested since 2013, and about almost 90% of our capital is still in play in companies that are active and we don't yet know the outcome. For the companies that we have invested in, have generated an exit, we realized out of 87 rounds of investment to date, 9 of those have generated a complete exit that has been a gain for our investors of about 1.7x. But the IRR in that case is ridiculously high because we had some very early, very quick exits that drive our IRR north of 1,500%. We don't talk about that much because it's perhaps a little bit misleading, but we do feel good about the exits we've been able to generate to date. On the flip side, we have had 7 rounds where we've written those off or taken a loss on those investments. So we are ahead of the failure rate curve that you'd expect at this point. Certainly our portfolio currently is much better than a 50% failure rate. Again, 7 rounds out of 87 to date. Certainly we'll have more failures over time. We know that. But we're hopeful that not only will we beat the 50% failure rate, but that our long-term IRR will be at least as good as the results you see from these studies. And based on both our portfolios, so we think that that's reasonable. So I want to stop there on the angel return study. Again, I'd be happy to take questions. Let me give you just a few quick updates on the regulatory front, some things that are important for angel investors and entrepreneurs to be aware of. Let me caveat this by saying that I am not a securities lawyer, and if you're operating in this space, you should have a good securities lawyer to make sure that you're getting really good legal advice on these things, which can be really critical. You can stub your toe and worse if you're not careful with these things. So I really just want to make you aware of some things to go ask questions about with your lawyer because they are important, and they are important public policy items that the Angel Capital Association certainly keeps close tabs on. So let me start with the Jobs Act, which was passed in 2012. There's about 5 major components of that. Let me focus on 2. One of those is the idea of general solicitation. From the 1930s up until this was passed in 2012, it was illegal for private issuers of equity securities, in other words, startups raising capital. It was illegal for them to talk about it publicly. You couldn't advertise the fact that you were raising money. You had to do it quietly if you were not going to be a public company. So if you wanted to talk about it publicly, you had to file an S-1 and go public and be subject to all the disclosures that a public company is obligated to report per the SEC. The law changed in 2012 to allow issuers to talk publicly about raising money. But the catch is that if you do that, you then have to take some extra steps to verify that the investors who invest in that offering are accredited. Accredited is a term that the SEC uses as a proxy for financial sophistication or risk-bearing ability. So folks that have at least $1 million in net worth, not counting their primary residence, or that have $200,000 in income as an individual the last 2 years and expected to have it this year, or $300,000 as a couple. If you meet those thresholds, you're an accredited investor, and the SEC says that you can take the financial risk to invest in these private companies that don't have to disclose as much as a public company would per the regulations that we mentioned a moment ago. So if you do generally solicit and advertise your offering, you have to ensure that the investors are accredited. So that means as the entrepreneur, you're responsible for verifying that the investors are accredited. You have to check their financial records or have a third party do the verification for you. That is obviously can be very sticky for investors who might not want to disclose that information to you, or to put that burden on a third party who may not want to take that liability either. So a little bit tricky for for entrepreneurs. So be very careful if you're talking about your startup publicly. If a news reporter is talking to you about your startup, be sure not to mention that you're raising money, because if that gets published in the paper, even if you didn't mean for it to, you've now tripped the wire and you're in the general solicitation bucket. which means now you have to go verify the accreditation of all your investors. So we encourage entrepreneurs to be really careful with that. If you don't generally solicit, if you don't talk about it publicly, then you don't have to verify the accredited investor status. You just have to have a reasonable belief that the investor would be accredited. So that's something to keep aware of. But one of the complicating factors with that is that the question arises, particularly with all of the accelerator activity we've seen over years, and lots of demo days from accelerators and incubators and university programs where startups are talking about their new venture and the fact that they need to raise capital. The question becomes, does that constitute a general solicitation? Are you talking to the public about that security and therefore now in general solicitation and therefore needing to verify the accredited status of your investors? There's a piece of legislation working its way through Congress now. It's been approved by the House, as I understand it, to carve out those demo days as not subject to the general solicitation rules, so you could participate in those events and not trip the general solicitation wire. That's called the HALOS Act. So we're looking for folks to support that. The Angel Capital Association on the public policy page has a lot of great resources about this topic and others. So we encourage you to get involved in that if you'd like by going to the ACA Angel Capital Association public policy section of the website. Another piece of the Jobs Act that has gotten a lot of press recently is equity crowdfunding. So again, prior to the passage of this law, not only could you now talk publicly about your investments, but you also couldn't raise money in any significant way from non-accredited investors. One of the pieces of the legislation that was passed in 2012 put in place some new rules for equity crowdfunding so that you could, in fact, raise money. You could, in fact, sell equity in your company to the crowd. So unlike Kickstarters and project-based crowdfunding, which are really just pre-selling a product, not equity in the company, these new rules allow issuers or entrepreneurs to sell equity in their company through crowdfunding platforms. So it took a long time for the SEC to actually publish and implement those rules, which actually just went live in May. There's 600 plus pages of these rules, so they're pretty complicated and pretty easy to get sideways, both for the portals that have to manage this and for the entrepreneurs that are doing the offering, as well as the investors that have to stay within certain income limits. So it's complicated. The only way to do it is through accredited, verified portals that are set up specifically to do this and follow the SEC's rules. So hopefully over time, this is going to be a great thing for democratizing access to capital and allowing non-accredited investors to participate. But we think in the short term, it's probably going to be fairly messy. Again, lots of regulatory hurdles to jump through, so there's probably going to be some mistakes made and toes stubbed in this process. There's likely to be some cases of some less than savory characters attempting to raise money this way. So hopefully over the next couple of years, as we get more practice and see this implemented in the market, we'll learn some things that will help make this easier and more workable going forward. We have some concerns about its viability in the short term, but we love the idea of giving more folks access to the capital marketplace, the ability to invest in promising early stage ventures. But there is a lot of risk associated. You've seen the failure rates we talked about with angel investing. So people do need to be aware of those risks and take it on themselves to really do their homework to participate in this market. So hopefully over time that will sort itself out. But I think in the near term, the word of the day is to be cautious if you're entering that world as an investor or as an entrepreneur. Last thing I'll mention here, the Dodd-Frank Act was passed in 2010 in the aftermath of the Great Recession. Lots of regulatory reaction to what happened that were some of the proximate causes of the recession. Tons of new regulatory pieces of that legislation for banks and parts of the market. The one piece that is important for us to talk about is that legislation mandated an ongoing review of that accredited investor definition I talked about a few moments ago. So every few years now, the SEC is required to review that definition. One of the things that's happening now in the review process is considering increasing those thresholds, the financial thresholds, the $1 million of net worth or the $200,000 or $300,000 in income. They already adjusted it a couple of years ago to exclude the value of the primary residence from net worth for the purpose of that calculation. Now we're looking at some additional changes that might include indexing those levels to inflation over time going forward. They might also create some standards above which investors are not limited in how much they can invest, while some that might be lower financial thresholds might be limited to how much they can invest. Some of the proposals, for instance, would be a maximum of 10% of net worth or 10% of income in a given year. So those are being debated. There's also a discussion about potentially broadening the accredited investor definition beyond just financial thresholds to folks that have certain know-how, experience, industry expertise, and or education levels that would allow them potentially to invest as accredited investors. So it's something we're certainly keeping our eye on. The SEC is continuing to take comments from their most recent report on this topic. And so we'll watch that closely. Certainly the last thing we want to see is a restriction of the accredited investor pool. We need those investors to be active in our marketplace. That's how we fund a lot of startups in this company that generate a lot of jobs. Well, in fact, they generate high growth startups, generate all net job growth in our economy. So it's really important that we make that capital marketplace efficient and give broad access. Again, people need to understand the risk, but the more we can give entrepreneurs access to capital and investors the opportunity to participate in that marketplace, the better off we'll all be. So we will continue to make the case, or try to make the case to the SEC that broadening the accredited investor definition is a good thing. Restricting it would be a very bad thing. So I'm going to stop there. I appreciate your patience as I walk through some of those slides. I spent more time on that than I intended to, but I'm going to now open it up for questions. And so feel free to jump in and let me know what's on your mind. So I'm going to start with a question from Paul Clark. Can you discuss how fees and expenses impact angel returns and compare them to other asset classes? Certainly, we can do that. It does typically require some expenses to manage these types of investments, particularly in angel investment, where it's a fairly inefficient market as opposed to public markets. We do have some overhead costs associated with doing this type of investment. In our case, we charge members a fee to join our group and have access, and we charge some fees to cover the cost of managing an investment over a period of time. We have to issue K-1s and make sure the accounting is done and get those tax returns out to people. So that is a hard cost we have to incur. And then, like most private equity venture funds, part of the incentive for the management to do this is to have some upside if those investments are to pay off and generate returns. Then we take a very small slice of the carried interest or profits from those investments net of the fees that we've charged on the front end. So on average over time, you can expect those fees to ultimately range between a couple of percent up to maybe 5% or so on the net result of an investment. Probably a little higher than you might expect in a public market, particularly if you're investing in index funds, that type of thing, where you might pay a fraction of a percent, although you probably get some ongoing account fees up to a couple of percent, depending on how actively you're trading. And so if you're a public market investor, you're probably going to pay a little bit lower fees, but you're also going to generate returns over time that are 7 to 10% in public markets as opposed to 20+% in the angel market. So if you deduct those expenses, you're still net quite a bit better off ultimately in this asset class than you might be in the public market. But again, it's a very risky asset class, so we wouldn't encourage you to put all your eggs in this basket. We typically indicate to angel investors you should think about 5 to 10% of your portfolio in this type of asset class, because it is very risky, and we certainly can't guarantee the returns that are benchmarks that we've seen over time. So I hope that answers your question, Paul, but happy to take any follow-ups. So the next question is from Squire. I'm sorry, I just saw this question. Squire Morgan. Look on our website. I think if you scroll down on the Crowder broadcast page, you should find a link there to the venturesouth.vc website. Venturesouth.vc, look for the investor page, investor resources, and near the top of that page, you'll see a list of topics that we've covered in our Crowder sessions, and you should find a link there to the slides. If you can't find that for some reason, we'll be sure to post this back to the Crowder site once we're done to make sure that you can get access to those over time. So apologies if that was not clear on the front end. The next question is from Paul. Can you discuss the timing of returns from early stage investing, years until return, when you start getting distributions, etc.? So again, if you recall from our discussion on angel investor studies, that typical hold periods can be anywhere from 3.5 to 5.5 years. And then some of the big wins, again, take longer to mature, and they might be 8-10 years to get those returns. Our experience is, as angel investors, we would like to generate earlier returns, and so we look for opportunities where we think we can generate earlier exits than that 8 to 10 year hold period. And in our market in the Southeast, we have less venture capital available to us, so a lot of those longer time frames you might see on some of those returns are where venture capitalists have invested large amounts of money. In order for them to get to a return that makes sense for them, it requires the company getting much bigger, and therefore it might take longer to get there. In our market, we have less venture capital at work. We might be able to scale a company a bit with just a couple of rounds of angel money and be able to get out quicker, but at a return that still makes really good sense and generates the kinds of IRRs we're looking for angels in a shorter time frame. So while we certainly expect that our average hold period going into a company, we look for 3 to 5 year hold periods. Our experience has been on our exits to date, we've been able to generate some fairly early exits. In fact, I mentioned our IRR is really high because the first significant exit we had took place in 4 months. And so that generated a ridiculously high IRR. We had a good return in 4 months, which kind of skews our IRRs overall. But on average, our exits have happened within 2 years, which is really, really fast. Again, that I think average will get longer over time as our portfolio matures, but we do look to try to get out in 3 to 5 years, ideally. As far as distributions go, it depends on the nature of the investment. There may be some cases, depending on the structure of the deal, where there may be some distribution that comes out in the short term. But generally speaking, we're not expecting distributions in the short term. We would rather have that cash reinvested in the growth of the company, because the faster we can grow the company, the higher we're likely to get, the higher return we're likely to get when we go try to sell that company to a strategic buyer that's interested in growth. So more often than not, we're not taking cash out of the business in the short term. We're reinvesting it in growth so we can get to a bigger outcome in that 3 to 5 year horizon. Hopefully that answers your question, Paul. But if not, come back with a follow-up. The next question is, what proportion of angels actually create a diversified portfolio and can therefore get the kinds of returns and studies? Well, that's a good question. I don't know that I can quote you a specific answer on that. I would say that in our groups, we certainly encourage people to build that portfolio over time. So I think a majority of them are working towards building that portfolio. We really say 10 is the minimum number of deals you need to be in over time, but really 15 is really the target. So to think through that math as an investor, in our case, it's a $5,000 minimum to participate in a deal. And so if you want to do this you want to build a portfolio over 2 or 3 years as an investor, and you're going to invest a minimum of $5,000 per deal, you need to be in 10 or 15 deals. That means you need to have a minimum of $50,000 to $75,000 to invest over the next couple of years, 2 to 3 years, to build that portfolio and give you a chance of success. I think we certainly have a number of investors who have done that. Unfortunately, I can't quote that number right off the top of my head, but that's part of the reason we have the process we do, is to give investors a reasonable chance to build a promising portfolio of 10 to 15 investments over the period of 2 or 3 years. We're investing in 6 or 8 new companies each year, along with 6 or 8 follow-on investments in companies we've invested in previously. So investors are not obligated to invest in any of those, but over the course of a couple of years, they should be able to put together a portfolio that gives them the diversification that they need. Brooke asks, are any regulatory filings required if I do donation crowdfunding? So as I understand the question, donation crowdfunding would be a Kickstarter or Indiegogo. In that case, no, there's no regulatory filing required, because that's not an equity offering. That's not equity in the company. That's essentially pre-buying a product. So that's just simply a trade transaction where you're purchasing something, a product or a service in advance, as opposed to equity in the company. When you're talking about equity crowdfunding, which is the new rule under the Jobs Act, the portals that manage that will be required to handle a lot of the processing of regulatory paperwork, as well as the issuer or the entrepreneur. Again, I mentioned there's 600 pages of rules around that. So really look to those portals to help navigate that. There will be some disclosures required, some reporting required, particularly the onuses again on the portals and the entrepreneurs to make sure that's buttoned up. But each of those portals that works in that space will walk you through those disclosures that are required. I hope I've answered your question there. Just briefly, if you're not doing general solicitation and you're not doing crowdfunding, but you're raising monies from accredited investors, it's a good idea to file a Form D with the SEC to let them know what you're up to. It's not required in most cases, but that is one regulatory filing you might consider as a startup that is raising funding. What are the different types of fundraising rules? Again, this is where you need a securities lawyer. There's lots of different ways you can raise capital. Again, depending on whether you're doing general solicitation, where you're focused on accredited or non-accredited investors. There's some newer regulations as part of the Jobs Act. It's a Regulation A+, which is a way to raise up to $20 or $50 million for non-accredited investors, but you're effectively having to disclose things the way a public company would, do audited financials, and incur a lot of expense and overhead to meet all the regulatory disclosures if you go through some of those other pathways. So the best thing to do is to get a securities lawyer to help you think through the right way to raise money. By and large, the things that we're dealing with are what we call 506B offerings. That's a rule that the SEC gives you to raise money from accredited investors. You can't have up to 35 non-accredited investors in those offerings, although as accredited investors, we tend to want to avoid that just to make sure we don't stub our toe with any regulatory issues. But if you don't generally solicit and you focus on accredited investors, 506B offerings are the way to go. You can raise an unlimited amount of capital with very, very little regulatory requirements in that case, as long as you're focused on accrediteds and you're not doing any general solicitation. But that's a much bigger question, lots of nuances and rules. And again, I'm not a securities lawyer, so I don't want to purport to be an expert on all of those. So I encourage you to seek out a good securities lawyer to walk you through those things. It can get pretty tricky. Zach has asked, do you think angel returns are correlated with other asset classes? That's a great question. I think we could debate whether they are or they're not. Anecdotally, I will tell you that there's lots of great examples of startups that actually started when other asset classes were down and went on to become household names. You can think of companies like FedEx and Cisco and many others that started in times when other asset classes were performing poorly, and then went on to be very, very successful companies. Lots of reasons why that might be in terms of being disciplined with capital and really being forced to be efficient with capital in times when other asset classes are down. But obviously, everything has been a cycle. I think angel investments can benefit certainly when markets are good. They can also be nimble and resourceful and survive better than maybe some other bigger companies that are weighed down by legacy costs and infrastructure when the economic cycle turns down. So we might have better survivability in those terms. So largely speaking, I'd say there is some reason to think that they might not be perfectly correlated with other asset classes. That'd be an interesting study. I don't know that I've actually seen anything that quite looks at that question directly. It would be interesting to go back and look at that over time. But I think, for instance, looking at the studies that we've cited in this discussion, we're looking at, again, the 2007 study was looking at late 90s through mid 2000s, and then this most recent study was looking at the period since then, and we see pretty similar returns over time. So again, you got to be patient in this asset class, but I think if you look at it over a fairly long period of time, those returns might be not particularly well correlated with returns to other asset classes. But it's a great question. I'm sorry I don't have a better answer for you, but I think there's a strong logic to think that angel investments and angel investors can do well no matter the economic cycle, again, provided that they really focus on the discipline and the diversification and the patience that it requires to get to the kind of returns that we talked about today. So Zach asked, why do you think these 20% returns seem so stable over time? Again, a great question. I think sort of touches on the prior one. Again, I think you could speculate that over a long period of time, these things tend to even out if you're diversified and you're patient. And you can sort of see the efficiency with which angel investors, startups like would put capital work and generate returns that make that sort of 20+% overall long-term average versus the 7 to 10% you might see in public market. Again, it's all risk and reward. So you're taking more risk by betting on new technology and new markets, but because we know creative destruction and markets are always evolving, those startups can take advantage of that sort of disruption and value creation opportunity to create bigger value over a long period of time relative to less risky investments where it's a little bit harder to go after maybe some of those newer opportunities because of the risk aversion and the capital base and the infrastructure that's in place. Kind of the innovators don't have a problem for other asset classes. So I'm not a macroeconomist. I'm not even a microeconomist. And so it'd be interesting to get some of those folks to weigh in on this question. But I think the fact that you've got creative destruction and you've always got entrepreneurs that are on the cutting edge of how markets are evolving and meeting new needs and solving new problems, I think it is proven to be sustainable over a long period of time that a diversified play in that asset class, which is an inefficient market at best, finding these startups and deploying capital in them certainly a much less efficient process than the public markets. And so some of those returns are not competed away like they might be in larger, more public markets. And it gives angel investors a sustainable advantage over a long period of time. Again, I'll beat this dead horse if you're diversified, diligent, and patient. What about interstate fundraising in South Carolina, North Carolina, or Georgia? Again, this goes back to some of the regulatory rules where you want to make sure that you've got a good securities lawyer that can help you. Through the 506B offering that I mentioned before and the Form D filing with the SEC, those sort of federal processes preempt state processes. And so if you follow the 506B process, state regulators have to yield sort of their regulatory authority to the federal agents at that point. And so you're covered in any state if you follow that process. You can do some intrastate offerings within states that might be advantageous if you're only raising money from folks inside a particular state. And those vary by state. And so you really, again, need a good securities lawyer that can help you navigate that. By and large, most of the startups we work with are raising money across state lines, and so they want that federal preemption. So they're going to follow the 506B rules. There are some new state-by-state rules that have been implemented around the equity crowdfunding piece, some of which would be superseded by the new federal rules, others of which might give you some more flexibility if you focus on investors just inside your own state. But again, that takes some legal expertise. You want to make sure you've got good, solid counsel on that front before you go out and make mistakes. So again, at the end of the day, make sure that you hire a good securities lawyer to help you navigate that. And Squire Morgan, how do you handle performance fees for accredited investors who are not qualified clients? When do you test for qualified clients? Again, qualified, I think, is another definition the SEC has with some higher thresholds. In our case, we don't make any distinction there. We are only focused on accrediteds. We are only doing non-general solicitation deals with 506B quiet offerings. So we don't have to verify any of that information. We just have to have a reasonable belief about their accredited status, which we get to know by knowing them as members of our groups and understanding their professional backgrounds and their involvement. And so fees for us across the board are the same. For all our accredited investors, again, they pay a fee to join the group. They pay a fee up front when they invest to help us cover the cost of that investment over its life. And then they pay a carried interest on profits from the deals that pay off. So those are the fees we charge. Those are standard across any investor. And again, they don't vary by investor. So the performance fees, if you're thinking about the profits interest or the carried interest, we typically charge in the neighborhood of 10% for that, which is about half what most private equity and venture funds charge. A 20% carried interest is pretty standard in the industry. But in our case, we're relying on our investors to help us with diligence and parts of the process. So we're able to charge them a lower carried interest for their participation in that process than you might see in a passive venture or private equity fund. I'm not sure if that answers your question, Squire, but I'll stop there. If you have a follow-up question, feel free to plug that in. As far as I can tell, that exhausts the questions that we have on our list. I'm going to wait just another minute or so to see if any other questions come in before we wrap it up. So as I'm waiting to see if any other questions come in, I'll say thank you very much for participating today. I hope that this at least whets your appetite for doing some more homework on your own to study angel investor returns, to study some of these regulatory issues that you need to follow if you're a startup or if you're an accredited investor. We want to point you to the right place to get at those resources. So again, check out our website at venturesouth.vc and investor resources or entrepreneur resources, and you'll find some links there that should be helpful. The Angel Capital Association public policy page is certainly helpful, as well as the Angel Resource Institute, where you'll find the angel return study that we mentioned today. I don't see any other questions at this point, so again, I want to say thank you. If you found this valuable and you'd like to make a contribution, certainly we would appreciate that. It looks like someone has contributed a bit. Thank you, Paul. Actually, I can't tell. It looks like that's an anonymous gift. So thank you, whoever that was. We appreciate it very much. And we encourage you to take a look at all of our Crowder sessions if you'd like to participate, or look back at what we've done in the past. Again, that's on our website at venturesouth.vc/investor resources. Thank you again for your time today. Hope you have a great week, and we'll see you next time on our next Crowder session. Thank you.